Hi, welcome everyone to our Oxford Elevate Economics for Business Leaders taster session. Oxford Elevate is the executive education program run by the Department of Economics at the University of Oxford. So it has some unusual features. First of all, it's executive education in economics. And so we find that these taster sessions are very useful to give people a, a taste of the kind of approach that we have to teaching and business education, which we think is unique. And I'll go through it now. So this taster session will come in three parts. The first will be a welcome and introduction to Oxford Elevate and the Economics and Business Leaders course. Then I'll go through a lecture, a short lecture, which gives you a glimpse of the style of education that we focus on and the potential value for your business. And finally, we'll sit down with two alumni, Kate Greenbank from the Cabinet Office and Philip Lustenberger from Novartis. And these are distinguished people who've been through our program, our Economics for Business Leaders course, and they will share some of their thoughts and experiences from the course with you. Okay, so that's the agenda for today. The environment that we're facing is one of volatility. We are in the midst of a variety of major structural shifts. That includes AI-driven transformation, organizational restructuring, labor market shocks, geopolitical fragmentation, reorientation, and redistribution of economic activity around the world, changes in supply chains, trade networks. We're all very familiar with this from what's going on right now. There's a huge amount of financial volatility, interconnected risk through markets that's been built up through financial integration. And there are productivity pressures, productivity crises in various economies, including the economy of the UK, which is where I sit today. How do we navigate these major structural shifts? Well, it requires an education that goes beyond, applying the lessons of yesterday. Because the environment is changing so rapidly, the lessons of yesterday may not fully apply to today. And so that creates an impetus to develop a structural understanding of the world. And that's what economics provides. Why does economics matter for business leaders? Well, how do economists think? What's the definition of economics? One definition is that economics is a subject matter. It's the economy, it's financial markets, etc. Another definition actually is it's a methodology. It's a way of understanding the world that goes beyond the particular subject matter. And that way of understanding the world is through models, informed by evidence and tested against evidence, but fundamentally thinking through models. And what are those models? They're like thinking machines that are simplifications of the world, but useful simplifications. Just like a map, your Google map that takes you to your destination or helps you to get to your destination is a simplification of the actual route and the actual world. It's a useful simplification. And so our thinking machines, our models in economics, are useful simplifications of the world that really help us to get a structural understanding of the world. And that's very important in a volatile environment when you have various shocks to the system. And we have to understand very quickly how that affects our business and how those shocks propagate through the system. That's what economics, I think, provides. It's unique. It's different to standard executive education. And I think it's very, very important for our current world. So the course, this Economics for Business Leaders course, will help us understand how markets, give us a structural understanding of markets and understand when they truly function, when they fail, how they shift, how incentives shape behavior, how risk is transmitted across interconnected systems, financial networks, supply chains, etc., and how long-term value is created. Economics provides this framework. And so we teach you really in this course how to think deeply about things, how to anticipate changes as they're occurring before others, and to really understand the trajectory of the economy surrounding your business and its implications for your business. Oxford Elevate, as I mentioned, is the executive education program based in the Department of Economics at Oxford. It is an unusually, maybe uniquely long-lived program. It's one of the longest-lived executive education programs in the world. It's been operating for over 70 years. How does it start? It starts with civil servants in London in 1953 who are in the midst of a very dynamic, changing post-war economy. And they want to understand that economy and how they can shape it. So they come to Oxford every summer, different cohorts come to Oxford every summer to do a 4-week-long course in economics, a deep and solid grounding in economics. And they believed that was critical to understanding the changes of their time. Now, this is operated continuously until today. It's changed as the economies change, but the importance of the course is no less than when it began, and maybe it's greater for the reasons that I've mentioned, because of all these structural shifts we're facing and the need to understand these shifts, the implications for one's business and for the economy as a whole. We introduce cutting-edge economics to business leaders. I think this is a unique part of our function. Within economics, there's a huge body of theory being generated, evidence that informs the theory and then flows back into more evidence. And there's a dialogue between the theory and the data that's occurring all the time, so that this does not remain stuck in the ivory tower. Oxford Elevate does a translation of this for business in a way that's really relevant to business leaders and is important for them to understand the dynamic environment in which they exist. So this is really about transforming the thinking of leaders to understand long-term consequences of various shocks to the system, trade-offs, systemic effects, strategy, etc. This is a photo from the Economics Business Leaders Program last year. We have delegates from around the world, and we find that it really transforms their thinking, and you'll hear a bit about that from our alumni toward the end of this session. Who is it aimed at? Well, the course is it's a select course, about 30 executives at the C-suite level or just below, senior decision makers within their organizations, join us for an online program and then culminating in a 1-week residential, as I'll provide more detail on in a moment. And they are from a variety of industries, from technology, finance, healthcare, energy, policy, etc. And they're responsible for strategy, investment, risk, and really they're in senior decision-making roles in their organizations. Often, there are many different profiles, but one particular profile is someone may be, say, in a pharmaceutical firm. They may have a biomedical background, and they're being elevated into a leadership position. For that, they need to understand the business environment, the changing macroeconomy. They need to be able to speak a certain language with investor relations, etc. And this course provides them with that language and the models for thinking through the business environment in which they find themselves. So this is the basic flow of the course. We start in May with a kickoff call, which really introduces the course, sets the tone, sets the expectations for this period from May to July. Then there will be 5 weeks of online lectures. How that will work? Each week is starts with an online live lecture introducing the material for the week and motivating it. So why is this material important for understanding the world today? Then there are pre-recorded online lectures on really key salient topics within economics, on strategy, on game theory, on the economics of AI, on markets, functioning markets and failing markets, on macroeconomics, debt sustainability, economic growth, trade, supply chains. So there will be online lectures broken up into topics during the week, recorded. Participants will watch those lectures, maybe will answer a few quiz questions, and at the end of the week, they'll have the opportunity to meet one-on-one with the tutors for the course. Now, the people delivering those lectures and the tutors are all Oxford faculty. They are at the forefront of their research fields. They are not hired specifically for this course. They are permanent Oxford faculty and distinguished researchers, all in their own right. And that's another unique feature of this course. So you'll have them through that really 7-week online period, 5 weeks of online lectures, and then the whole program will culminate in a residential week in Oxford from the 6th of July to the 11th of July. And that residential week is a really intense week where everyone gets together. All of the knowledge from the previous 5 weeks or 7-week period really is brought together, and they're asked to apply it in various ways. There are very, very there's a lot of intense contact with your tutors, who again are permanent Oxford faculty, and there is a huge amount of time allocated to discussion questions, and a really kind of free-flowing discussion between tutors and participants among themselves in a classic Oxford tutorial style. Oxford. So Oxford is the oldest university in the English-speaking world. Teaching started here in 1096. Now, for an organization to survive a millennium with all its changes, with intact and at the forefront of its field, is a remarkable feat. And how has it done that? It's done that through various forms of built-in adaptability. And one of those is the tutorial system, where faculty meet in small classes, sometimes one-on-one to one-on-three, with students, full faculty, and that allows a kind of tailoring of the program to the current needs that really is not possible in any other system. And we continue that tradition within Oxford Elevate and apply that to executive education. Oxford is ranked #1 on the Times Higher Education World University Rankings. It's one of the world's leading universities in terms of teaching and research. And as I mentioned, there's this tutorial model which is at its center. It's also a huge network, a global community of scholars, leaders, and alumni with very strong links across the world, Middle East, Asia Pacific, Europe, USA, etc. Now, the Department of Economics within Oxford is ranked #1 in Europe. It's #4 globally, depending on the rankings. And this is the home of Oxford Elevate. Oxford Elevate, as I mentioned, is an executive education program that's not really separate from the university department. It's housed within the department, and it fulfills a lot of the department's objectives in terms of external engagement, taking this deep, rigorous research that's produced within the department and taking it out to business and government and policymakers. We have about 50 faculty members, and the research is at the cutting edge, as you can imagine. So today's session is going to give you a taste of the style of teaching that we emphasize in Oxford and we take to business and government through Oxford Elevate. It's not just theory, it's really a way of thinking about the world structurally that helps you to understand the world better, form your strategies better, and to make decisions under sometimes radical uncertainty in a way that is rigorous and properly accounts for that uncertainty or indeterminacy of the environment. Okay. So let's start the lecture now. The topic today is the economics of financial bubbles. In any organization, we'll have to deal with financial markets. And financial markets, even if you don't have to seek finance, financial markets are connected to the real economy. And so any business will have to contend with fluctuations in financial markets. Now, financial markets can behave in a kind of normal way, near equilibrium, and just go along in normal times, but they are subject also to abnormal, let's say, well, these abnormal fluctuations can be quite normal, as we see in financial markets. They're subject to potentially large swings and phenomena that really upset the equilibrium. So we can be very far from equilibrium at certain times. And a key example of that is financial bubbles. So let's try and understand a little bit about financial bubbles. This will just be a short lecture, so just give you a taste of what we could do in a longer format, which is what the courses, the Economics of Business Leaders program is about. But this will give you a taste. Okay, financial bubbles. History of financial market is marked by financial bubbles. One of the most dramatic cases is tulip mania between 1634 and 1637 in the Netherlands. Now, at this time, the Netherlands has the Dutch have a global empire, a huge amount of global trade is going through the Netherlands, and financial markets have been developed in the previous century, pioneered by the Dutch, in fact. And we see, with all this prosperity that's been created, a bubble that forms in tulip bulbs, of all things. One of the most sought after tulip bulbs is pictured on this slide, the Semper Augustus. The bulb at the time sold for 5,500 guilders, which is more than Rembrandt's night watch at the time, or equivalent to a weight of gold around $660,000 today. So that's a lot. These were traded in taverns. They were auctioned in a particular way, and a huge bubble formed. Prices rose dramatically up until February 1637, and then fell around 90% in February 1637. Even common bulbs, bulbs that were widely available, not like the Semper Augustus, which was quite rare, shot up 20-fold and then collapsed to 1/20th of their peak. So this is a kind of archetypal financial bubble. If we go back to something closer to our time, we can go back to an earlier technological revolution just before our AI revolution today. And that is the internet revolution and the dot-com boom that came with it. Speaking in 1996 at the American Enterprise Institute, Alan Greenspan really popularized this term, irrational exuberance. And what he was talking about was that as risk has been controlled in the environment, interest rates come down, and these low interest rates could possibly give rise to financial bubbles. And he called this, he described the process by which these bubbles inflate as irrational exuberance. And this was 5th December 1996. So this term has been used to describe bubbles ever since. It features as the title of a very famous book by Bob Shiller, who won the Nobel Prize for his work on this very issue. Before that bubble, Greenspan speaking in 96, we'll go back to the dot-com bubble in a moment. But if you go back before that, but not as far as the tulip mania, what you see is the Japanese bubble between 1986 and 1991. It is the first peak on the slide is the inflation of the Japanese bubble. It crashes in 1989, between 1989 and 1992, but really just keeps going. And it only really recovers its highs very recently, about a year or so ago. The Japanese stock market briefly surpassed the US stock market in capitalization in 1989. And the average PE ratio is about 50. So if you look at this paper here by Ken French and Jim Paterba, these are efficient market people. They say that fundamentals really cannot explain this bubble. At the peak, Tokyo real estate, which is an important part of this bubble and probably the most dramatic part of this bubble, sold for about 130 up to 139,000 US dollars per square foot, which was nearly 350 times the price in Manhattan. And so by that valuation, the Imperial Palace in Tokyo was worth as much as California. So this was a huge bubble. The dot-com bubble you can see here. When Greenspan made his comments, the bubble really was not going. The bubble starts later, about 1989. And so that tells you that there's a lot of people may call a bubble. And if you start to invest, liquidate your investments or short the market at that time, you could get into big trouble because bubbles can go for a long time. In fact, if you had bought at the time Greenspan made his comments expressing concern that the market was overvalued, you would have hardly lost any money after the bubble, if you sold after the bubble burst. So really the bubble comes after, and the bubble bursts dramatically. You have about 85 to 90% decline in various technology stocks. And this goes on for 2000 and really hardly recovers until 2007, just before the next crash. If we look at the dot-com boom, the company that was at the center of it was a company named Cisco. And everyone thought that boom was a picks and shovels play. The internet infrastructure was key. You wanted to own the servers and the routers and various other parts of the internet infrastructure. And you see, then the blue line is Cisco's stock price, which just skyrockets up until March 2000, after which it crashes and only really gets up to its previous high relatively recently. NVIDIA, you can see in 2000, is really about producing chips for graphics chips for video gaming. And it then takes off as people realize, NVIDIA, Jensen Huang and others realize that these chips can be used for AI. And you see this huge boom today, and that is the picks and shovels play of today. What is a bubble? A bubble is, according to Charles Kinderberger, one of the key authors on this topic, a bubble may be defined loosely as a sharp rise in the price of an asset or a range of assets in a continuous process, with the initial rise generating expectations of further rises and attracting new buyers. Then it's followed by a sharp reversal. So it's this interaction amongst different types of traders that's the key. The strategic interaction is the key to the bubble, and it's going to be key to our understanding of these financial market fluctuations. There are many factors that are conjectured to be important in terms of inflating bubbles. And one is marketability, easy credit, speculative surges, and so forth. But let's look at the actual evidence on it. First, some historical bubbles. How do we define a bubble? Well, we can define it as these authors, Quinn and Turner, define it: a rise in asset prices of at least 100% over less than 3 years, followed by at least a 50% decline in less than 3 years. So the bubbles go back almost to the start of financial markets, of large-scale financial markets, stock exchanges, for example. And we see the Mississippi bubble in France, South Sea bubble in the UK, which was a huge issue here. Many other bubbles, railway manias, the Roaring Twenties culminating in the crash of 1929, Japanese bubble I mentioned, the dot-com bubble, the subprime bubble, which burst in 2007, 2008, various Chinese bubbles and so forth. And there's a real question of whether we're in an AI bubble at the moment. And we don't have time to go into that, but we could go into that at length. What does economics have to say about this? Well, economics, as I mentioned, is about thinking through changes in the world using models. And those models have to be informed by evidence, and those models generate extra predictions that we then take to the data and we update our beliefs. And this is the process that economists find themselves in. Let's start with the experimental evidence on financial bubbles. What we find is that bubbles are a fundamental property of asset prices. They're hard to really remove from asset markets, and I'll talk about that in a moment. This should just give you an overview. Then we can have mathematical models. How do we understand these bubbles? Are they rational? Are they subject to psychological biases? Are they social movements? We won't deal too much with the observational evidence. It's very hard to understand whether we're in a bubble or not, to test empirically whether we're in a bubble or not. That's difficult. I'll talk a bit about how bubbles can make inference more difficult. And then we'll think about the effects on the real economy. Are bubbles purely destructive, as we often think about them, or are they a part of creative destruction? Can they be productive, or can they benefit the real economy in some way? And we'll go through that. Now, this is Vernon Smith. Vernon Smith won the Nobel Prize in 2002 for his work on experimental markets, examining in lab settings the behavior of markets, whether they be financial or non-financial markets. Now, it turns out when goods are non-durable, that means you can't trade them. You buy the good, you consume it. You can't then sell it on to someone else. Everything behaves very much as economic theory predicts. Price is very close to the actual value of the good, and there are no unusual phenomena. But the moment you introduce durability, that the asset can be traded, you have a financial asset that can be traded, you can buy it, hold it, sell it, then you get bubbles under a very general set of conditions. And it's very hard to remove these bubbles. Okay, so here's an experiment. This is one of Vernon Smith's classic experiments and co-authors in 1988. Each trader receives an initial portfolio of cash and shares of a tradable security. The security pays a dividend of 24 cents each period for 15 periods, after which it matures and you get a zero payout. So the value of this security declines over time as more of the dividends are paid out. Think of it as a gold mine with a fixed amount of gold, and the gold is just generated, and so the value is going down over time as the gold is sold and the dividends are paid out from those proceeds to investors. On this graph here, what you see is this stepped line is the fundamental value of this security, which is decreasing over time. The dots, these black dots here, capture the behavior, the trading behavior, the price at which the trades occur when there are experienced traders. And what do experienced traders mean? Experienced traders are traders that have played the game before with each other in the same group. And so the trades occur very much in line with the fundamental value and the decline in fundamental value. But where you get inexperienced traders who've never played this game before, those are the diamonds. Their trades are represented by the diamonds. And what you see there is that the prices at which they're trading far exceed the actual fundamental value of the security for quite a long period of time. The trading volume is very high, sometimes 5 to 6 times the outstanding shares. And the swings are large. Eventually the bubble bursts, but it inflates for some time. Now, there is no uncertainty here about the fundamental value of the security. Everyone knows it. You know what dividends are going to be paid out each period, and at the end, it's going to be worth nothing. There's no fundamental uncertainty. But what there is strategic uncertainty. Individuals when you elicit their beliefs, are thinking, oh, maybe I should buy it now, even though the price is higher than the fundamental value, because I can sell it to someone else who may value it or even more, because they think they can sell it to someone else at even more. But eventually that bubble pops. But it's very hard to find a setting in which those beliefs do not form and a bubble does not form. So common experience of trading in a stationary environment is required, as we'll see, but public information about the fundamental value of the security is insufficient to induce trading at the fundamental value. These bubbles are a very robust feature of asset markets. How can we avoid bubbles? If you introduce short selling where someone can bet against or bet on the deflation of the bubble, there's no effect. The bubble still form. You can introduce brokerage fees just to tax trading, so you don't have too much trading. This reduces, but does not eliminate the bubble. You can have futures markets which tell us about their beliefs, other people's beliefs about where the bubble will pop. Same thing, does not eliminate the bubble. You can constrain liquidity, amount of cash people have to buy with. Same thing. You can have a sophisticated subject pool, mid-level corporate managers, OTC stock dealers, etc. They're going to behave exactly the same. You can introduce financial education. That is, you have a group of economics graduate students read Vernon Smith's original paper and then trade with others. This only reduces the bubble if they're trading with experienced traders and the same experienced traders over time. If they're matched with uninformed traders, they try to pop the bubble, but the uninformed traders overwhelm them and the bubble forms anyway. And actually the informed or educated traders get wiped out. So only when they're matched with the same group of experienced traders are there no bubbles. That is, you can't introduce new generations of traders, they're going to inflate the bubble. You can't change anything about the environment, change the dividend structure, change the cash that they have to trade with. That's going to reignite the bubbles. And so it's very hard to get away from bubbles when you have asset markets. That is the conclusion of this experimental research on financial bubbles. Now, why do we get them? There is a theory of rational bubbles. What is a rational bubble? If we go back to Jean Tirol's paper, Jean Tirole is another Nobel Prize winner in economics. If you have a fully rational model in his environment of trading, you're not going to get bubbles. Okay, that's the benchmark result. That is because to get a bubble, you have to believe you're going to buy it at the price at above fundamental value because you believe someone else will buy it at even a higher price, and they will buy it from you because if they believe that someone else will buy it at even higher price, and so forth. Someone at the end is going to be holding the bag, and the question is, in a fully rational environment where you can do backwards induction, well, then no one is going to want to be holding the bag at the end of the game. And so the next person along, the penultimate person, won't want to buy at a price above fundamental value because they have no one to offload the security to, and the person 2 steps back won't want to, and all the way back. So that is Tirol's result, no bubbles. But what Blanchard and Watson showed is that if you have continuous trading, so the value of the security never goes to zero, you can get bubbles forming. And this is some maths here. I don't have too much time to go into it. I will actually leave it. But it tells you that there is this bubble component in the price series, which is perfectly consistent with rational optimizing behavior. The bubble has to grow at a certain rate, and it's very hard for it to continually grow because it could exceed the size of the economy. So there are some constraints of bubbles. It really has to pop at some point. But you can get a rational inflation of the bubble at some point. But we typically think that these are not entirely rational phenomena. It's really the interaction between traders with different informations, prior beliefs, or biases that generate these bubbles. Now, if we go back to the theory of efficient markets, these bubbles should not exist, according to people like Milton Friedman or Eugene Farmer. If there's some mispricing, rational traders should quickly come in and bet against that and eliminate the mispricing quickly. But there are various limits to this kind of activity, limits to arbitrage, and Schleifer and Vishny go through some of these. There's fundamental risk that, the security is trading above fundamental value, so you want to short sell it, but then the fundamentals can shift against you. Or there could be noise trader risk, as I mentioned with the Vernon Smith experiments. You could be overwhelmed by uninformed or irrational traders. And the third thing rather is that there's coordination risk. To really pop a bubble, you won't be able to do it by yourself. It requires coordination amongst a large group of traders or significant group of traders, large players in the market. And you may not be sure that they will coordinate with you. And we're going to go through an example of that in a moment. Um, so that those are all limits to popping bubbles quickly. What often happens is that traders ride at the bubbles. It may benefit them to ride the bubbles. And that's Brewer and Brunnermeyer's work. And in fact, there's even modeling that suggests that traders may try to inflate the bubble so they can ride it and then time it before the crash and make more money than they would by trying to bring the security price back to fundamental value. There's empirical evidence of this. Temin and Voth look at Hawes Bank during the South Sea bubble. They rode the bubble and sold just before the crash and made a large profit. Brunnermeyer and Nagel look at hedge funds in the dot-com boom, and they can look at their positions stock by stock, and they can see that the large hedge funds, the Soros funds, Tudor, Tiger, etc., were able to mostly time the downturn. They were able to sell just before the crash. But not everyone sold. Stan Druckenmiller, you see this quote here on the right, he was managing one of the Soros funds, the Quantum Fund, and he actually got caught out. He invested, in 2000, in February and March 2000, I believe, and did lose a lot of money and resigned immediately from the fund. He wrote, "We thought it was the 8th innings and it was the 9th." So the timing game is a dangerous game. Let's think about popping bubbles. 1992 sterling crisis is an example of a speculative attack. Actually mentioning Druckenmiller. Druckenmiller was the one really behind this, along with George Soros. And what they understood was that the British pound, which was at that point pegged to especially the Deutschmark, but the exchange rate mechanism, the European exchange rate mechanism, could not be defended. That peg against mainly the Deutschmark could not be defended. And so they decided to attack it with a huge position. You can see what happens to the pound over time in September 1992. The UK government responded by raising interest rates actually to 15%, but still could not defend the peg, and they had to break it and leave the ERM. This was a coordinated attack. The position was so large that once other traders saw this position being taken, that coordinated their beliefs and led them to join in this particular attack. Let's go a bit deeper into a model of this kind of coordinated attack. The central bank maintains a currency peg. Okay, so this is we're getting into some modeling here. We can do more or less of this on the course depending on the audience, but this gives you an idea of how economists think about these things. Central bank maintains a peg. Speculators can attack the currency or not. You need more than one speculator to attack the currency for the peg to be broken. In particular, we're going to assume that you need, of the set of large traders that can do this, you need share P, okay, proportion P of those traders, which is greater than some level theta to attack the currency for the peg to be broken. Theta is the level of fundamentals. That says how many traders need to coordinate on attacking the currency for the peg to be broken. If theta is low, very few need to coordinate to break the peg. If theta is high, a lot of speculators need to coordinate to be able to break this peg. Let's think about their payoffs. If the attack is successful, each attacker receives a payoff of B minus C. If it's not successful, that is, if you get less than a proportion theta of the large traders attacking, then everyone just pays the cost of the attack, which is C, but they don't get the benefit B. A speculator who does not attack, it just gets a safe payoff of 0. Now, let's suppose the fundamentals are unknown. All you don't know is what other players will do. That is a strategic uncertainty. You don't know how many other players will attack if you attack. There are what we call multiple equilibria here in economics. And this is a very important point. A lot of the financial systems, economic systems, social systems exhibit a form of fundamental indeterminacy that is strategic indeterminacy. We don't know exactly what players will do. There are multiple equilibria. It could be that no one attacks and the peg survives. But if you expect other people to attack, you attack. Everyone else expects everyone else to attack, and the peg is broken. And so we don't, which one happens? We don't know. Both could happen. Both are equilibria. And that's a form of fundamental indeterminacy. And that can, various signals can be used to coordinate our behavior. And one of those is signals about fundamentals. This is based on a model of Morris and Shin, very briefly. Suppose now that the fundamental value, theta, is uncertain. That's the share of traders that you need to attack the currency for the peg to be broken. Each trader receives some noisy information about this fundamental. That's xi for trader I, which is the true fundamentals plus some noise. You can now, each trader can now condition whether they're going to attack the currency based on the signal that they receive. Typically, if you receive a very weak signal, a signal that the fundamentals are weak, that theta is low, that's the xi is low, then you might want to attack. Otherwise, you don't want to attack. And in particular, if the noise is small, you're going to get a unique equilibrium here. There exists a threshold x star such that each trader attacks if and only if their signal is sufficiently low. That is, if I say the fundamentals are bad according to my signal, I'll attack. If the fundamentals are good, I'm not going to attack. And at the tipping point x star, the player is indifferent rather. And under, in a salient case, what happens is this tipping point. What is this tipping point? It's just C over B, the cost of attacking the currency divided by the benefit. And the peg is broken if the actual fundamentals are below some theta star, some threshold. Otherwise, the currency remains in place. The currency peg remains in place. So fundamentals may fall a bit, but it doesn't mean that necessarily we have to get an attack on the currency. But what happens is this changes in the fundamental coordinates people's strategic beliefs and gets them to attack together the currency, even though the peg could survive if they didn't attack. So the information on fundamentals is playing a coordinating role. And also you see here that even if fundamentals remain high, if, for example, the cost of attacking the currency falls, you could get a speculative attack without any changes in the fundamentals. So this is all exploiting our understanding of this strategic uncertainty and this indeterminacy here, and the connection between the fundamental uncertainty and the strategic uncertainty. So the lessons. Although outcomes can be hard to predict, fundamental uncertainty leads to exact predictions or very more precise predictions. Even a small amount of aggregate uncertainty can affect the likelihood of a currency crisis dramatically. And the fundamental uncertainty helps to coordinate expectations. This can be applied to all kinds of things. Debt rollovers, what's so-called bond vigilantes, could they attack the US dollar, US bonds, bank runs. Even though the bank is solvent, everyone may think that other people are going to go to the bank and try and withdraw their money, so you want to go to the bank. And if everyone does that, then there's going to be a run on the bank, and the bank is going to be illiquid and have certain problems. Technology adoption, political risk like revolutions, these all are coordination outcomes, can be modeled in the same way that we've modeled popping bubbles and currency crises. Okay, how do we draw inference in financial markets inferences in financial markets when we have bubbles? Well, the problem is this. This is what happens to the S&P 500 last year in April when tariffs are announced, Liberation Day. What happened was the market fell dramatically. The question is, was that because of the tariffs per se? Is that how much value the tariffs destroyed? Or is it that plus any correction in mispricing which is triggered by this news? We don't know the exact mix. It could be a bit of both. So because news is a coordination device for selling a bubble, the reaction to news reflects the true economic impact plus the correction of previous mispricing. And that is a very interesting part of, or implication rather, of bubbles for our ability to draw inferences from movements in prices in financial markets. Now, finally, are bubbles destructive? What is their effect on the overall environment? We have this notion of creative destruction from Joseph Schumpeter, and that is that old businesses get destroyed, but they get replaced by new ones, which are dynamic and more efficient and more innovative. And then they become older and they get destroyed. And that's how progress and capitalism and economic growth and development work. Well, how do financial bubbles affect this process, which is a process in the real economy? Well, bubbles create these manias or fads and so forth, which are not entirely destructive potentially for the real economy, because they can help, it can increase innovation by overcoming entrenched market power, low risk tolerance, financial frictions, positive externalities that everyone has to time their investment together, right, with data center build out, for example, and other dynamic inefficiencies in the economy. So it could be that bubbles are actually adaptive at a higher level of organization than the individual or firm. Sometimes they're purely destructive, but not always. We're seeing a big structural shift, as I mentioned at the very start of this session, and that is a AI transition. This was recently Salesforce. So this is at the start of this month. Salesforce was down 23% for the year to date. And that's because software firms in general have been reevaluated in because of the innovations in AI technologies. And the question is, can these LLMs and AI agents do the work of software firms, but in a much more bespoke, efficient, low-cost manner? And this is a big concern. Hedge funds, investment funds have been mulling through this over the last few months. And this is part of the transition that's going on. Here's on the right, we see Block. A few weeks ago, fired 40% of its workforce. How did the market react to that announcement? Did they say this is crazy, they'll never be able to manage the transition? No. Their stock went up 24% in a day. And this is being repeated across the economy today. And this is part of the major transitions, one of the major transitions that we're going through. Okay, so here are some of the insights. Bubbles are a robust feature of asset markets. We have to deal with them when it comes to financing and navigating financial markets. Decision-making in these settings must account for two forms of uncertainty. One is strategic uncertainty, what is everyone else doing? And another is fundamental uncertainty. Really, what are the fundamentals here? And they interact, as we saw. Changes in fundamentals can help coordinate investment booms and speculative attacks, and the price impact of news effects can go beyond fundamentals to creation or correction of mispricing, and that these bubbles, finally, are not necessarily destructive to the real economy. So this is a brief taste of a brief tour through some of the economics of financial bubbles, and this is a key part of dealing with financial markets. Okay, thank you. So okay, you should be able to see me now. Is that right? Okay. Okay, now we're in the final part of our session. Well, we're going to deal with questions and answers at the end, but this is a time when you get to hear from alumni from the Economics of Business Leaders program, and you get to learn a bit about their experiences and what they gained from it, how it may have informed their decision making, and what's different about the program. We welcome Kate Greenbank from the Cabinet Office. Hello, Kate.
Hello.
And Philip Lustenberger from Novartis. Hi, Philip.
Hi.
I want to start by asking Kate, and then I'll go to Philip. How's the program changed the way you approach decision making or strategy in your current role?
Thanks, JP. Well, it's brilliant to be here today. So
Fantastic.
Thank you for inviting me. To answer that question, I think I probably first need to clarify what it didn't change for me, because I think that's a really important distinction. So I work in the UK civil service, And the Treasury and our individual ministries are full of professional economists. So when I came back from Oxford, I didn't suddenly start writing the formal economic cases for our programme, business cases, because that is still very much the job of the government's economists. So I work in a central government advisory team in the Cabinet Office, and we work on the government's most critical commercial challenges. So UBEP, or Oxford Elevate, of course, as you are now, didn't change the content of my job, but it did change my understanding and my approach to my job, because I find myself asking different questions now. And I consider new contextual areas that I wouldn't have thought about probing before. And it means that the strategic advice that I'm giving government departments is a bit sharper. It's essentially given me a new lens through which to view our commercial framework guidelines. And as you said earlier, JP, it's a different way of understanding the world and a different structure. If I have a couple of minutes, I could give you an example of how this is playing out in practice for me on something I'm working on currently. So I'm currently supporting the Department for Farming and Rural Affairs with something called the Nature Restoration Fund. And I now, thanks to this course, understand that in economic terms, this environmental recovery programme is a response to a textbook example of a market failure, meaning that there are no current market mechanisms which account for the true costs, true social costs of an action. And in this case, the action is house building, and the cost is environmental damage. And there's no natural marketplace which exists to price and trade these environmental costs and benefits. So as my esteemed economist colleagues say, this gap is referred to as a missing market. So the Nature Restoration Fund is government's strategic intervention to establish this missing market. Primarily, this is to unblock the planning process and build a lot of new houses, because environmental concerns are the biggest blocker to planning. But how do we create this missing market? And how do we buy environmental recovery efficiently? So that's broadly the question that I'm trying to answer. And Oxford's sessions on markets and auction design have been particularly useful for me. So that's been highlighting how to structure bidding environments, how to design reverse auctions to ensure maximum ecological benefit for the taxpayer. And then we also looked in the programme at contract design and moral hazard. So when government funds conservation measures via third parties, so that might be farmers or NGOs or habitat banks, we use economic frameworks to manage that supplier behaviour. And my advice to departments on how we can think about embedding rigorous monitoring or financial backup measures mitigates that moral hazard. And that helps us maintain incentives to the supply base. So Oxford definitely hasn't turned me into an economist. I would require more than the expert teaching that I did have, but it has given me some economic fluency, so that I can ask the right questions or better questions, and I can challenge some assumptions, and I am hopefully designing better commercial strategies, which are sort of more fundamentally rooted in how markets behave.
Fantastic. Okay, thanks so much. Philip, can I turn to you?
Yeah, thank you very much for having me. So, same as Kate, it hasn't changed the fact that I'm a scientist, trained as a scientist. I have been working for 25 years in pharma research and development. And in 2024, just 1 month before the program started, I was promoted into a new role where all of a sudden I had to talk more frequently to my new commercial team members, upper management, outside Novartis, stakeholders. And the program has really provided me with the vocabulary and some key concepts, and you call them the models of how to think through certain situations. I can give you an example. Something I really like and I try to use when possible is the game theory approach, strategic reasoning. If I have to develop a program, a development program, and I'm not the front-runner program, I have information from my competitors sometimes. This informs my next step, and I can decide whether I follow or whether I branch out and do something different. In the same context, there is the topic of information and signaling that comes in. So, for example, what is the suitable point in time for me, now representing a pharma company for a specific program, to signal to the outside world that we're doing something similar or different? There's a lot of strategic reasoning behind what to hide for another 6 months or what to go forward with in order to create a signal that then creates a new action with regards to support of our programs or a shift in perception. So overall, as mentioned, for me, I'm still working as a scientist. I'm still leading very scientific teams with clinicians and technical development and toxicologists. But the vocabulary that I have now allows me to ask my commercial team better questions and understand certain concerns when they talk about market sizing, creating markets, restrictions in markets, limitations, and so forth.
Okay, fantastic. Thank you. To whoever wants to answer this question, actually could go to either of you. Was there a particular session or moment during the course that shifted your thinking or stayed with you? You've already partially answered these questions by, with game theory from Philip and from Kate from auction theory. But can you remember a specific point in the course or particular lesson that really has stuck with you? Kate, I think you're muted. So.
Yes, happy to answer that first. So I did have an aha moment when we started looking at monetary policy, because I think before I attended Oxford Elevate, I viewed things like central bank interventions, inflation targeting, quantitative easing. I just sort of viewed them as these abstract high-level macroeconomics. And as I mentioned earlier, we have brilliant economists across government who handle formal economic modelling. So I think I just used to think really that level of monetary policy sat quite far removed from my day-to-day work. But the monetary policy specific lecture shifted my thinking and really brought this to life, because then it made me realise how macroeconomic volatility isn't just a high-level government finance issue. It is actually a direct, immediate threat to the resilience of supply chains. So if I'm working on a commercial strategy for a major multi-year outsourcing contract, for example, I'm now going to pay more attention to how exposed our potential suppliers are to the wider economy. If central banks are aggressively tackling inflation, what does that mean in terms of cost of borrowing and capital? What might that mean for them, to their supply chain? And because I have to assess and manage the risk of inflation at the pre-procurement stage, I've got much better understanding now of the why behind that rule. So I'm now asking, are we trying to force the market to absorb pricing risks that are completely outside of their control? Because if we do, then they're just going to be baking in a massive, expensive risk premium, which is going to be terrible value for money for the taxpayer, or worse, the contract's going to become completely unviable for them. So that was a bit of an aha moment, because it gave me an understanding, which gives me more confidence to ask better questions about risk allocation, because we need to shield our suppliers from macroeconomic shocks that they can't control, but at the same time we need to incentivize them to manage the costs that they can control. So it was just that kind of, okay, I get it now. So it just sort of making sense of something quite practical that previously had been very conceptual for me, if that helps.
Yeah, I think there's a general lesson there that, a lot of our jobs, what we work on, we're experts at certain things, and we break up the world into these chunks, right? I'm an expert in this.
Silos.
Silos. And really, a lot of value can come from understanding the systems at play. That is the connecting information between all of those silos. And there's a separate silo that you think is independent, but actually that your silo is connected to. And
completely. And sometimes the question I ask is, can we get an economist in the room, please?
Yeah.
Because I'm not one, but I've got a better understanding of when we need an expert to give some advice.
Yeah, but to deal with them, you have to have a common language, right? And a common way. You have to have some common terms of reference,
Yeah.
and so it's very
Well,
important.
my
And that's
vocabulary
one
definitely expanded after the residential week in Oxford.
Yeah, and fantastic. Philip, did you have similar experiences?
Yes, indeed. I mean, I really enjoyed the online
Yes.
lectures to prepare, to have time to study the subject, to do extra readings. Also, the tutorials at the end of the week were very insightful to me. The immersion week in Oxford itself, the lectures were fabulous. The case studies, I really loved them. What happens in the lunch breaks and the breakfast breaks and so on is also quite important, because we were colleagues from banking, oil, consumer care, consulting, and as mentioned, we were only three from pharma. Coming from a typical pharma bubble, being surrounded with pharma people was very refreshing, seeing how those colleagues approach risk, innovation processes. We had very deep discussions over the breaks. The example I wanted to share still is there was one lecture I really loved. It was from Matt Palmer, who did the development of London Heathrow Terminal 5, a huge project which I knew as a place, but he shared all the things behind. And I mean, there's the technical and infrastructural component, which is already massive, the whole logistic, but also he was referring to the cost of ecological impact, the growing business for BA, British Airways, that this had a massive boost as a consequence, basically created for them a market. Also, the topics of freight being reshuffled, sort of reshuffling streams of and flow of materials, attracting people, attracting work to London, with all the impact it had then on GDP. He brought so many concepts that we heard as individual components. He brought so many concepts together, and we had also a very deep Q&A then. So that was some session that really stuck with me.
Okay, fantastic. Did you also benefit from interactions with your peers in the course, Kate? They're drawn from quite a variety of industries.
Yeah, that was one of the richest parts of the experience for me, actually. In my job, I deal with suppliers from multiplicities of different industry sectors. And on the course, I found I was sitting in syndicate groups with leaders from exactly those same kinds of companies. So it was Novartis, Shell, Accenture, NatWest, others on my course. And one of the biggest challenges that I face in my job in public sector procurement is information asymmetry. So, the reality is for us is that the market typically knows far more about their internal commercial pressures, their risk landscape, their operational structures, or their cost drivers than we do. And quite aside from the delightful company of the people on the course, because it was really a terrific bunch of people, it was just great to spend time with these private sector colleagues, because it opens your eyes to what life is like on their side of the fence. Really interesting to hear what the real world pressures are in different industry groups, especially as people were bringing that lived experience to the case studies and the tutorials. So yeah, really helpful and a lot of fun as well. I mean, the camaraderie on the course was absolutely amazing, and you and all of the faculty were very approachable and fun. So thank you for that.
And was there, maybe I'll address this to Philip, but has there been any continued interaction with either your peers on the course or the alumni network?
There is still some connect through LinkedIn. We have still the group, and also within Novartis, I'm staying in touch with one person specifically. I got to know through your program a person at Novartis much better, and we're now basically exchanging on a relatively frequent basis.
Fantastic. Kate?
Yes, I've been in touch with a few of my fellow attendees. You arranged a reunion with with in London, which is obviously much easier for me to get to than many of the international colleagues. But it's brilliant to know that, because we got to know each other quite well over the week. I mean, I would say to people on this taster call, it's a very intense program. You can't do your work in the margins. You can't bring your work from the office and do that in the margins. You've got to give it your full attention. So it really is very demanding, but it's huge amounts of fun, and you get to know people very quickly. And I have stayed in touch with a few, and it's brilliant knowing that I actually consider that I have a pretty trusted cross-industry network that I could reach out to now, both professionally and personally. So if I'm looking at a particular challenge in a particular sector, I know that I could pick up the phone and reality check some assumptions with somebody who understands that specific market. So yeah, the program has definitely given me a wider network and built some resilient contacts.
Fantastic. Well, thanks so much, Kate and Philip. And thanks for sharing your thoughts on the program. I think this is very valuable for
You're
people
very
who are
welcome.
thinking
I
about it.
encourage anybody to consider it. It's a very valuable use of your time.
Fantastic.
Fully
Thank you.
agreed.
Thank you. Now,
So JP, now we have a few Q&A in the Q&A chat. We have a question for you.
sure.
Sorry. I don't know if you can read it. I can read it out loud.
Let me have a look. Okay. Raoul from London. Is artificial intelligence an equalizing technological platform accessible to all, or is it a capitalist product that reinforces global inequalities, especially in countries with low literacy rates? For example, India, and I'm just going to shorten this a bit. Yes, so this is one of the new topics for the coming year, the economics of AI. And we're going through it. Obviously, this is transition that we're going through. It's really difficult / impossible to stop. It's about adaptation, a proper adaptation, I think, at the individual level, at the organizational level, and at the society-wide level. Depending on the society-wide political adaptation of it, the process can go in different directions. And I've written about that personally. I have a paper called The Political Economic Risks of AI, which gets to exactly the concerns that you're expressing in that question. And that explores a particularly negative trajectory, but there can be also positive trajectories. But it all depends on how political institutions adapt. And we'll be dealing with some of the economic fundamentals of this transition in the course. And I think that's a very interesting, new, current, and very evolving part of the course. The fact that we have tutorials, the fact that you have a small class interaction with professors who are at the forefront of their research on this topic means that the debate, the discussion can be very current. Very current. It could be about things that went on that week or in the days preceding the tutorial. And so that's the kind of format I think which is ideal to deal with these very dynamic, evolving, and volatile phenomena, such as this AI revolution and the adaptation to it. Any further questions? We have one in the chat, right? Oh, no. The chat is different.
For the moment, it's only one question in the Q&A. I don't know if anyone has more questions. Please post them in the Q&A and JP can answer them live.
If there are no more questions, let me say a few things briefly. And one is that, and I echo some of the comments of Kate and Philip, some of their reflections on their time on the program. It's a unique program because it's economics executive education, but that economics really is important for understanding the world today, just like Raul's question just then on the economics of AI. This is something that concerns a huge amount of people. Changes in the monetary system, debt sustainability, trade shocks, supply chain reorientation, all of these issues are very current issues. I hear a very, very broad range of people speaking about these issues and dealing with these issues, and they're fundamentally economic issues. So to be able to deal with these issues right now with economists who are really leaders in the area, I think is a very unique experience. And then the fact that you can spend, after 5 weeks of, rigorous lectures translated for people in business and government, you can spend a week in Oxford, experiencing Oxford, seeing the sites, basically being immersed in the teaching system, the tutorial system, and being with a group of, I think, really extraordinary people. I found the participants to be really, each have their own unique personalities and perspectives and specializations. But when they come together, I think there's some magic that happens. And you have people that form, I think, very long-term relationships and connections, both professional and personal. And I think this is, a hugely important, this network that's created. And also you're plugged into a larger network. The course, as I mentioned, has been going on for over 70 years. So you're plugged into this big network that's lasted for a very long time. And I think that is another very valuable thing. It's intense, but that is part of the value of the course and part of the enjoyment, I think, of it, that you're really immersed in Oxford for a week and get to see it in a way that you otherwise wouldn't see it unless you were a student here. But it gives you an idea of the place, the style. There's very relevant content, and I think a fantastic set of people to interact with and to learn from and to connect to.
We have one more question in the Q&A.
Martin, fantastic. Do you have any specific advice on how to make the most of the residential week in terms of advanced preparations? Yes. So the residential week is really the culmination of what's happened before in the 7-week period before. There is 5 weeks of online lectures, as I mentioned at the beginning, which really sets out the main economic concepts, facts, models to understand. And then there are some opportunities. So there is a live lecture at the beginning of the week, the online recorded lectures which you have to work through. And then to make the most of that, sign up for the one-on-one meetings with your tutors who are Oxford faculty at the end of each week. Interact with them, ask them questions, get the feedback. If you've done all of that, by the time you get to the residential week, you'll be in a great place to deal with the residential week. And then the residential week, you have all of this time. It's not like you're thrown into it and you have no time for feedback. You just, you have to download all this information. It's not like that. There are, again, lectures, but there are long periods of tutorial discussion where you get to ask questions about, any blind spots in your knowledge, things you don't understand, and also applying the material, which is kind of a general way of thinking about different areas like macroeconomics or game theory. All of the things have been mentioned by Kate and Philip, but applying it to your own role and your own profession. You can ask the tutors that, you can work through it in those discussion sections with them. And I think this is a hugely valuable part of the course. Any further questions?
So if anyone prefers to type their questions by email with more time after you have digested this lecture, I put in the chat the email address that you can reach out to us. And so please do, if you have any kind of questions, we'll be more than happy to help you with that. I've also put the link to our website and with the dates for this year's program.
Okay. Thank you, everyone. Thank you, Kate and Philip, for joining us. And thanks to all for attending.
You're most welcome. Thank you.
Thank you very much for having us.
Thank you.
Thank you, guys.
Bye.
Bye-bye.